Today we're going to learn how to maximize the cash value in a whole life insurance policy and what's the most efficient way to accomplish that. In order to do this, let's go back a little bit to how insurance used to be sold and it was sold on an annual guaranteed renewable basis with the premium rising each year. So as you can see here, $116 would buy $100,000 on a 40-year-old. But as time increased, every year the premium would go up. Now, I ran this policy beginning in year 10 because I don't sell and I cannot illustrate a policy that shows an annual renewable term insurance. It's not really commonly sold anymore, but that's the way insurance used to be sold. And the problem with that is that there was no equity developed in it. So insurance was sold on a year-by-year basis. It could be renewed without underwriting, but the premium went up every year. Essentially, what this meant is that you had to pay more and more every year to have the coverage that you had, but you developed no equity. So money spent on term insurance was really money down a rat hole unless you died. And as we stated, this type of insurance never builds up any equity during the entire insured's lifetime. Secondly, what came out is a level term insurance that the insurance companies sold. This is still a product that is good and can be sold today. I sell this product still yet, only if we has the option to convert this product to a whole life insurance policy. The reason that is that this gives a young family an opportunity to buy insurance at a fairly inexpensive cost. Yes, the first year's premium is greater than if you were buying an annual renewable term product, but you get a level premium for a guaranteed certain amount of years. No equity develops in this policy, and as you can see, after the guaranteed level renewable premium drops off, then we start seeing the cost of insurance rising as well here. So this is the type of product that the insurance companies came up with when people realized that every year that was going to cost them more. And so the insurance companies realized that they needed to make this more comfortable and affordable for people to afford. The problem is this product still doesn't allow any equity to build up in it for the policyholder. And so, again, you're just leasing a death benefit from an insurance company on an annual basis, and there will be no payout to you unless you die, and then it goes to your beneficiaries. In this illustration, you can see that the level period is for 15 years, but then after that, the premiums start to increase again because the probability of the insurance company actually having to pay out a death benefit rises, and they have to cover the risk that they're exposed to there. As said earlier, neither one of these term policies develops equity, and that's why it's only beneficial to buy this kind of term if it's convertible to whole life where you can build equity. So let's take a look at a whole life policy for $100,000, just like the two term policies we've been looking at. And with whole life policies, we are guaranteed a level premium for an entire lifetime. That's the reason it's called whole life, is because you have this whole life guarantee that your premium will never go up. Granted, the premium is much more expensive, about 12 times more expensive, or at least 10 times more expensive than what you would pay for a one-year renewable term, and a little bit, and even if you look at level term, it's more expensive than that too. But the good news is that you've got a column here called cash value, and that cash value, when we get down to year 15, is greater than the sum of all the 15 years of premiums you paid in there. That means that for the first time, when whole life insurance was sold, that the policy holder was able to develop equity. That is because they were starting to purchase an asset called PaidUp insurance in a policy. And like any other asset, equity can develop in it, and the equity here is shown as cash value. Now, what happens is any type of equity that you own, you can leverage, you can surrender, or you can sell, okay? And the same thing is true with life insurance equity. So how do we take that equity and maximize it? And that's where a unique rider called the PaidUp Editions rider comes into force. This rider allows us to almost triple the amount of money that we were paying into that whole life insurance policy. And in doing so, we're able to purchase an extra $10,842 of coverage. That extra $10,842, though, is something you own instead of something that you're leasing. And so each year, as you can see here, the amount of paid up insurance, or the insurance you own, gets greater and greater. So by the time we get down to year 9, you have $86,000 of paid up insurance, and that makes your death benefit rise. Now, that $86,000 has a cash value, which is $37,829 by year 9. And that means that at this point, you have already created more equity in this policy than what you've paid in premium. So instead of taking 15 years like in a basic whole life policy, we're now able to shorten that time period so that you maximize the cash value in a short period of time. From here on out, your cash value will always be greater than what you've paid in premium. And so now this policy is generating an internal rate of return for you as well. Now, notice that if we keep paying this premium until we're 55 in this case, or 15 years down the road, there's $73,000 of cash value. And that is a significant amount of cash value that you could either leverage, surrender, or sell off. And you have not paid that much for it. And so that's the definition of an asset, is something that generates money for you. And that's what we have here in a participating whole life insurance policy. So if we earmark those extra premiums that we're paying toward the paid up additional rider here, that's what happens. Making sure that that rider falls within the IRS guidelines is very important, however. Otherwise, the cash value that you do develop could become subject to taxation and a 10% penalty, just like qualified plan money is. And that means that the policy would have become a modified endowment contract. So we want to follow the rules. We want to fully fund or maximize the payments to that PaidUp Editions rider, but we don't want to step over the IRS guidelines. Now, another way that's really getting to be quite commonly used is using a term rider. And people will use a term rider in designing a policy. So now, instead of starting out with $100,000, $110,000, we're adding an extra $100,000 of term insurance onto this policy. Same base policy of $1,262, as you can see down here in year 16 when the term rider falls off. But what happens is, because the death benefit has been elevated, the IRS then allows a little bit more premiums to get into this policy, into the cash values without it becoming a modified endowment contract. However, it's still not as effective as the policy with the that's maximized the PaidUp Editions rider, because part of the money that was used to buy that term insurance cannot be used to buy PaidUp insurance. And so when we get down here to year 15, we don't have as much cash value as we did in the whole life policy that had the maximized PaidUp Editions rider on it. In fact, there's less than 15% more cash value in this than what you've paid in premium by year 15, whereas in the policy that had the maximum PaidUp Editions rider had nearly 19% more cash value than what you paid in premium. Big difference. So term riders raise the death benefits, like we said, and we want to make sure that even still we don't overfund this policy. The other thing that we need to be aware of is that that term rider has to stay on there for at least 7 years. If it doesn't stay on for at least 7 years, then what happens is the policy automatically becomes a modified endowment contract because the death benefit drops much earlier, and now the death benefit to premiums paid to cash value is disproportionate to the IRS ruling. So these policies can be beneficial for someone that's doing some interesting estate planning, or they can also be beneficial for an elderly couple that's seeking to provide an income for the surviving spouse because they didn't buy insurance earlier on in life. As you can see, $3,547 is less expensive than the $3,900 that was paid for the whole life policy with the maximum PaidUp Editions rider on it. So we can lower the premium a little bit and still get a high cash value and a higher death benefit. And that's why this policy is a good option for elderly couples that are looking for a non-taxable income to be passed on to the surviving spouse, or maybe even for some type of exotic estate planning. All in all, there's 4 things that we need to be aware of when we're thinking about maximizing cash value. The best way we have seen is to fund the PaidUp Editions rider as completely and fully as we can without violating the IRS rule. Because overfunding the policy will create a modified endowment contract, and a modified endowment contract can be put you into tax consequences that are not real favorable for you. Term riders can be helpful, like we said, for elderly people who need additional coverage but can't afford the premium of a whole life policy or a whole life policy with a maximum paid-up insurance rider on it. And it's also beneficial in some estate planning options. And finally, be very aware of the limitations that a modified endowment contract can place upon the cash values in a participating life insurance policy. Unless you're doing some exotic estate planning, like we mentioned, you'll want to avoid the penalties and the taxes that the IRS imposes when a life insurance policy is overfunded and becomes a modified endowment contract. Hopefully this has been beneficial for you. If you have any questions or concerns about a policy you own or you're thinking about purchasing, whether it's maximizing the cash value so that you can use that money to create the best money management system for you, give us a call at 702-660-7000. We're always happy to do that free evaluation for you.
Hey guys, thanks for watching this video. If you enjoyed it, please give it a thumbs up. Also click the subscribe button to enjoy the latest content and newest videos on the channel.